Welcome to this week's episode of The Wealthologist, your go to source for insightful wealth management and financial planning guidance. Today's episode, Watching the Fed. Yet again, right? I'm your host, The Wealthologist, Chris Hobart. And, the purpose of these is to dive deep into the heart of financial markets and economic trends to give you some idea of what matters most to you and your finances right now. Now, this week in particular, it is a really crucial week for both investors as well as economists because there is a ton of economic data that is set to hit the news. Things like new home sales to GDP, also consumer incomes, and a lot more. So, a really big week. And each piece of this financial puzzle, well, it shapes our understanding of what we think the Federal Reserve might do. What's their next move with interest rates? And again, we've been talking about interest rates for the past year and a half, 2 years. And the big question on everybody's mind is, will they cut rates this year? So let's kind of jump back about a month ago. A month ago, the futures market was saying the Fed's going to cut rates 5 or 6 times, which, to put that into percentages, that's about 1.25% to maybe 1.5% of cuts. But that's changed in the past month. The expectation has shifted to maybe 3 or 4 cuts, which is about 0.75% to 1%. Now, why this change? Well, two strong unemployment reports came in, as well as a surprise uptick in Q4 GDP data, and that caused that rethink. Now, I want you to remember, just as things changed just over this past month, these expectations can and will shift as quickly as they're formed. So I want to delve into something that's maybe not often in the limelight, but is really crucial. And this is what's called the M2 money supply growth. Now, this measure of money supply, it didn't spike back at the Great Recession back in 2008 and 2009 because there was a stringent regulation on banks forcing banks to increase their reserves. So as instead of money supply is increasing, they held reserves. And that happened even as the Fed was printing money or putting money into the system. Now, in 2021 or 2020 and 2021, it's a different story. The M2 shot up by about 40.7%. And that was driven by banks injecting money into the economy. Think about those PPP loans. Now, that surge laid groundwork for inflation to really spike in 21 and 22. Now, in the following year, M2 actually declined by 3.2%, which helped ease inflation without hampering economic growth. So that's just an idea of money supply. But I want you to understand the twist. In the last 2 months of 2023, M2 started growing again. Now, it was at a pretty moderate rate of 4.1% annualized. But if this trend continues, it actually might be a silver lining, potentially reducing the risk of a recession later in the year. Now, there's something else I want you to keep your eye on, and that's going to be the relationship between long and short interest rates. Now, back in October of 2022, we saw the 3 month Treasury yield, or the interest rate paid on a 3 month Treasury, surpass the 10-year yield. This is what's known as an inverted yield curve, and you might remember Jacob talking about that in past meetings that we've had online. Now, traditionally, this signals a tight Fed and a looming recession. But in today's context of abundant reserve monetary policy, this interpretation it actually may no longer hold water like it used to. You see, with the Federal Reserve funds rate largely influenced by the Fed's decisions rather than market forces, the old rules of the yield curve, they actually may need more reevaluation than they have in the past. You see, the Federal Reserve's influence extends deep, deep into our economy, and more so, it seems like each and every year. You see, since 2009, interest rates have been kept below inflation about 80% of the time, which leads to market and banking distortions. Now, the Fed, they seem pretty confident in their ability to adjust rates in line with economic data. But the thing I got to warn you is this could be a bit overly optimistic. But the economic indicators are not all rosy. when we look at them. Let's look at things like retail sales. They've dipped in 3 of the last 4 months. Things like manufacturing, excluding automobiles, it's down for the fourth consecutive month in a row. And the housing market, it's taking a bit of a hit too, with some pretty sharp drops in housing starts, in housing completions, as well as with new home sales. So I know what you're thinking. Chris, what should we do? Well, the thing is, as savvy investors and as financial enthusiasts, what should they be doing? Let's learn from others. I want you to keep a close watch on the M2's path. It's going to be a key indicator of the economy's direction in the coming year. That money supply is going to be very important. We're going to be keeping our eyes on that, and that's something you need to be looking at as well. We'll be talking about that more in the months to come. But to summarize what we've talked about today, while the economic landscape is complex and it's always changing, when we begin to understand some of these key indicators from interest rates to money supply growth, that's where it becomes crucial. Now, that's our job. And as we navigate these different financial waters, staying informed and agile is going to be paramount, which is why we manage the portfolios the way that we manage the portfolios. Doesn't mean that we're always 100% on par, but it does mean that we're trying to stay agile to work within the economy. All right, that's it for today's episode of the Wealthologist Weekly. I want you to join us next time as we continue to explore the fascinating world of wealth management and financial planning, how they intersect and how they make a big difference in your life. Until then, keep your investments smart and your future brighter.